In the course of my work, I talk to many people, and we talk about real estate. What surprises me is how many of them are waiting to buy. They delay their purchases, expecting prices to crash, enabling them to pick up properties at the fraction of current prices. How real are their expectations? Let's start from the beginning. For the longest time, the real estate market was held back by the interest rates. High mortgage rates created really strong incentives for the potential sellers to stay put, even when they needed to move up or downsize. It is hard to sell your home that was financed at 3% interest rate and get a new one paying 7% interest or even more. Many homeowners decided to remodel, build additions, or just adapt to their current homes instead of selling and buying a better fitting property. This drove the number of homes available for sale to record low levels, while continuously driving the housing prices up. Many buyers got discouraged by the combination of the low inventory, high interest rates, and growing prices, and exited the market. They waited for market conditions to improve. The number of sales plummeted, and some news sources started talking about the new real estate bubble here in the Bay Area. But since the beginning of the year, the interest rate started on a downward trend and it reignited the market. In September, the number of new listings increased by 22% in Santa Clara and San Mateo counties compared to the same time of last year. The number of home sales, however, increased by only 6%. The number of new contracts, the number of listings that accepted purchase offers in September, also increased by 14% year over year. The number of homes coming to the market was outpacing the number of homes sold, and the number of properties available for sale by the end of the month increased by 26% compared with September of 2023, and by 15% compared to August. At the same time, the median time on the market increased from 9 days in September of 2023 to 12 days in September of this year, and the average time to sell grew from 22 days to 25 days over the same time period. The average overbid, the sale price to the list price ratio, dropped to an average of 4%, the lowest number since January. Overall, here in Santa Clara and San Mateo counties, the median home sale price growth slowed down to 2.3%, the lowest year-over-year increase since June of 2023. The availability of homes for sale in September was up by 26%, and prices grew by only 2.3%. Is it the beginning of a new housing crash similar to the Great Recession? With the background of Teamsters strike blocking U.S. ports, elections, Bay Area tech and biotech companies laying off people, and ever-revised unemployment and other economic data, will home prices be able to persevere and maybe even continue to grow? Will the increases in the available inventory and slower price growth burst the housing bubble, triggering the second housing market crash since year 2000? Most likely, the answer is no. Majority of real estate economic experts expect home prices to continue growing while at a slower pace, increasing but slower than in previous years. Current situation is nothing like 2006, 7, or 8. Back in 2008, the homeowner equity was estimated at $9.65 trillion. It was the first time when homeowners' debt on their houses exceeded the equity since the Fed started tracking data in 1945. On another hand, now the home equity is reported at $33.8 trillion, with 2/3 of homeowners having more than 50% equity in their homes. Even though home prices look inflated, due to the amount of equity, nobody anticipates an avalanche of foreclosures, repeating the Big Short scenario. The supply of homes is expected to remain lower than historic averages, especially because new construction across the U.S. did not keep up with the population growth. New home starts for years stayed well below pre-2008 level. The Bay Area market is predicted to stay in seller's market territory for the foreseeable future. At the same time, the Feds indicated that they will continue to drive the interest rates down. At their September meeting, they lowered the prime rate by 50 basis points, the first rate cut in more than 4 years. They also indicated that they will continue to lower interest rates, and it is expected they will decrease the rates by an additional 0.5% before the end of this year, and may continue downward rate adjustments in 2025. Most economists predict that buyers will rush back to the market when the mortgage rates drop below 6%. At the time of this video, the mortgage rate is hovering just a bit over 6%, according to the Freddie Mac's weekly mortgage rate survey. Lower mortgage rates will improve housing affordability, will bring more buyers to the market, and in turn may drive home selling prices yet higher again. And don't underestimate the impact of the presidential elections on the real estate market. Housing market activity decreases by an average of 15% a month or so before and after the election day. Looking back, home prices went up in 7 out of the last 8 presidential elections. The only exception was 2008 election, and we all remember what happened then. This is Michael Talis with the Talis team. If you are thinking about buying or selling a home within a year or even 2, let's get together on the phone or on Zoom to review what you need to do to enter the market and to complete a successful purchase or sale. My contact information is in the description of this video. Keep in mind that I'm available in the evenings and on weekends, at the times when you are off work. I'm looking forward to connecting with you. Till next time.